There is a force quietly steering the lifeblood of global finance, shaping the fate of banks, yet unknown to most. The Basel regulations, the invisible architecture of modern banking that silently molds the system. Basel is a calm and unassuming city in Switzerland. Yet inside it lies an institution so influential that it directs the world economy without making a sound. The Bank for International Settlements, the central bank of central banks. Late 1970s, the global financial system was in turmoil. Banks were collapsing, countries were on the brink of default, crises had become routine, and in that period, the world's most powerful central banks gathered and asked a single question: who should decide how much risk a bank can take? This question marked the birth of the Basel Committee. In 1988, the first major step was taken. Basel and the committee's goal was simple, but its impact was enormous. Banks would be required to hold capital according to their risks. This was revolutionary for the world of finance. From now on, a bank could not take risks far beyond the money it actually held. And for every risk it took, it would need to build a safety cushion. Order had been established, but the world kept changing. In 2004 came Basel II. This time, the focus wasn't just the amount of risk, but the quality of that risk. Banks now had to analyze their borrowers far more deeply. In a sense, the financial system was being made smarter, but even then, the calculations were incomplete, because the 2008 crisis struck Basel II at its weakest point: liquidity. Gigantic banks that looked flawless on the surface suddenly found themselves unable to obtain cash. The Basel rules were placed back on the table. Out of the ashes of the 2008 crisis emerged Basel III, one of the toughest banking reforms in history. Banks now had to prove not only their risk and capital adequacy, but also their liquidity, leverage ratios, ability to withstand unexpected shocks. Basel III was essentially saying, no matter how big a bank is, there is no guarantee it cannot fall. These rules made even the largest financial institutions tremble. Holding more capital meant higher costs. Stricter liquidity meant reduced freedom. Yet this discipline became one of the pillars holding the system together. Today, the Basel rules affect not only banks, but loans, interest rates, national economies, and even people's everyday financial behavior. Why is a loan rejected? Why do banks raise interest rates? Why does a country's banking system appear more reliable? More often than not, the reason is the silent force behind the scenes: Basel regulations. Basel is not a law, not an imposition, but a global standard that all major banks in the world must follow. To understand the invisible architecture of today's financial system is to understand how the world actually works. Basel is not a city, it is an idea, an invisible financial civilization that quietly influences the world.